Welcome to Chapter 9, Behavioral Finance and Technical Analysis. Traditional finance often begins with a clean model. Investors process information rationally, compare risk and return, and make consistent choices. Behavioral finance begins with a more awkward observation. Investors are human. We get overconfident. We anchor to old information. We chase what just went up. We hate admitting losses. We divide money into imaginary buckets and then act surprised when every bucket belongs to the same household. That does not mean markets become easy to beat. Irrational investors are not the same thing as free money. A mispriced security can become more mispriced before it corrects. Shorting can be expensive. Funding can disappear. A correct thesis can arrive 3 quarters before the market feels like agreeing. As the old market line reminds us, being early can feel remarkably similar to being wrong. This chapter connects 3 ideas. First, psychological biases can shape individual decisions and sometimes market prices. Second, limits to arbitrage can allow mispricing to persist even when sophisticated investors recognize it. Third, technical analysis tries to read market behavior through price, volume, breadth, relative strength, moving averages, and sentiment. The market anecdotes are familiar. During the dot-com era, investors extrapolated extraordinary growth far into the future. During housing booms, recent price appreciation was treated as evidence that appreciation would continue. During the meme stock episode in early 2021, social narratives crowded short positions, option activity, and a short squeeze collided. Each episode involved human behavior, but none offered a simple low-risk trading rule. We will use behavioral explanations as hypotheses, not excuses. We will ask what bias is proposed, why arbitrage does not remove it, whether the evidence survives out of sample, and what remains after cost and risk. Markets are made of people, institutions, incentives, and constraints, not calculators floating in a vacuum. The good news is that people are interesting. The less convenient news is that they are also the competition. By the end of the chapter, you should be able to diagnose behavior without turning every bad trade into a psychology seminar and evaluate technical signals without treating a moving average like a crystal ball with a Bloomberg subscription. This chapter has 4 practical learning objectives. First, you should be able to explain behavioral critiques of purely rational investor models. Traditional models are useful because they create disciplined benchmarks. Behavioral finance does not require us to throw those models away. It asks where actual decisions depart from them and whether those departures are systematic enough to matter. Second, you should identify common information processing errors and behavioral biases. Information processing errors include overconfidence, conservatism, and extrapolation. Investors may believe their forecast is more precise than it really is, update too slowly after meaningful evidence, or infer a lasting pattern from a very small sample. Behavioral biases include framing, mental accounting, regret avoidance, and loss aversion. The same economic choice can feel different depending on the reference point or the label attached to the money. Third, you should describe limits to arbitrage and explain why mispricing can persist. An arbitrager may face fundamental risk, model risk, implementation cost, short sale constraints, financing risk, client withdrawals, or career risk. A portfolio manager who is correct in the long run can still be forced to close the trade in the short run. Markets do not provide extra credit for eventually being vindicated after the fund has been liquidated. Fourth, you should connect technical indicators to behavioral stories while evaluating them skeptically. A moving average crossover may be described as evidence of trend following. Market breadth may indicate whether an advance is broad or concentrated. Sentiment measures may attempt to identify excessive optimism or fear. But a plausible story is not the same as a profitable strategy. The rule must be specified, tested out of sample, adjusted for risk, and evaluated after trading costs and taxes. The assessment focus is application, interpretation, and judgment. Definitions are necessary, but they are not enough. A strong answer explains how the bias changes a decision, how the constraint affects a trade, or what evidence would make the signal more credible. In other words, do not merely label the investor overconfident. Show me what the investor did, which assumption was overstated, what damage followed, and which process control could have reduced it. Psychology becomes useful when it changes the investment process. The chapter is organized around 4 connected questions. The first question concerns biases, forecasting errors, overconfidence, conservatism, extrapolation, framing, regret, and mental accounting can affect how investors gather information and act on it. These biases are not interchangeable. Overconfidence can produce excessive trading and oversized positions. Conservatism can delay a necessary update. Extrapolation can turn 3 strong quarters into a permanent growth forecast. Regret avoidance can keep an investor in a familiar but deteriorating position because selling would make the mistake feel official. The second question is prospect theory. Investors often evaluate outcomes relative to a reference point rather than total wealth. A $1,000 loss may feel more painful than a $1,000 gain feels pleasurable. That asymmetry can help explain the disposition effect, selling winners too quickly to secure a gain while holding losers too long to avoid recognizing a loss. The brokerage statement does not care whether the loss has been emotionally recognized. The account value has already received the memo. The third question is limits to arbitrage. Mispricing can persist because exploiting it is risky, costly, and time sensitive. A short seller can face unlimited upside risk, rising borrow fees, a recall of borrowed shares, margin pressure, and clients who redeem at the worst moment. Model risk matters too. The security may look mispriced because the model is wrong, the accounting is incomplete, or the analyst has mistaken confidence for information. The fourth question is technical tools, moving averages, market breadth, relative strength, support and resistance, and sentiment indicators attempt to summarize market behavior. These tools can be useful as descriptive dashboards or as parts of a tested process. They become dangerous when a visual pattern is treated as proof, especially after the rule has been designed around the same chart used to celebrate it. The 4 questions belong together. Bias may create the pattern. Limits to arbitrage may allow it to survive. Technical analysis may attempt to detect it. Testing determines whether the pattern is actually useful. The goal is a usable mental model, not a vocabulary list. A behavioral story without a constraint is incomplete. A technical signal without a test is decoration. And a profitable backtest without realistic implementation is often just historical fiction with better formatting. This slide brings together 6 concepts that students should be able to define and apply. Overconfidence means overestimating the precision of beliefs, forecasts, or personal ability. An overconfident investor may use a narrow range of outcomes, trade too frequently, or size a position as though uncertainty has been politely canceled. Confidence is not the problem. Uncalibrated confidence is. Conservatism means updating beliefs too slowly after new evidence. Suppose a company has a long record of stable margins, but several quarters reveal a structural change in competition. Conservatism can cause the analyst to treat meaningful evidence as temporary noise because the old story is comfortable and well rehearsed. Extrapolation means inferring a broad pattern too quickly from a small sample, recent winners are assumed to keep winning. A new technology adoption curve is projected indefinitely. A strong month becomes a 5-year thesis. The market has always had a generous supply of straight lines drawn through temporary trends. Mental accounting means treating money differently because of arbitrary labels. An investor may take excessive risk with a bonus because it feels like house money, keep a low-yielding savings account while carrying expensive credit card debt, or judge each position separately instead of considering the total portfolio. The labels feel real. The household balance sheet remains unconvinced. Prospect theory says utility depends heavily on gains and losses relative to a reference point. Losses tend to hurt more than comparable gains feel good. Investors may become risk averse when protecting gains, but risk seeking when trying to avoid locking in a loss. This can produce inconsistent decisions around the same underlying wealth. Limits to arbitrage are the forces that prevent rational traders from removing mispricing quickly. Fundamental risk, implementation cost, short sale constraints, timing uncertainty, model risk, and funding pressure can all matter. A strong answer does more than name the concept. It identifies the evidence, connects the concept to the decision, and proposes a process improvement. For example, the investor is extrapolating recent social media winners, which increases concentration and entry price risk. A position limit and a written valuation range would reduce the damage. Naming the bias is diagnosis. Changing the process is treatment. A disciplined behavioral claim should move through 6 stages. Step 1 is observation. Identify the actual price pattern or investor behavior. Be specific. Did investors trade more after gains? Did a stock continue rising after positive earnings surprises? Did a moving average rule appear to avoid large drawdowns? People were irrational is not an observation. It is a conclusion arriving before the evidence. Step 2 is bias. Name the psychological mechanism proposed. Overconfidence may explain excessive turnover. Conservatism may explain underreaction to new information. Extrapolation may contribute to momentum or bubbles. Loss aversion may help explain why investors hold losing positions. The mechanism should fit the behavior rather than being selected because it was the first term remembered from the slide. Step 3 is constraint. Ask why arbitrage does not remove the effect. Is the security difficult to short? Is the trade crowded? Is the holding period uncertain? Could the mispricing widen enough to trigger margin calls or client withdrawals? A behavioral explanation is incomplete if sophisticated traders can eliminate the opportunity instantly and cheaply. Step 4 is test. Specify the rule in advance, use clean data, and evaluate it out of sample. Include delisted securities. Avoid look-ahead bias. Do not adjust the moving average length 12 times and report only the version that survived. If a strategy was discovered by testing hundreds of variations, the victory speech should be shorter. Step 5 is risk. Determine whether the return is compensation for exposure to market size, value, liquidity, crash risk, or another factor. An unpleasant risk premium can look like mispricing until the unpleasant part arrives. Step 6 is decision. Decide whether the evidence is actionable or merely descriptive. The correct action might be a trade, a portfolio constraint, a rebalancing rule, an investor coaching intervention, or no action at all. Imagine a claim that stocks rising above their 200-day moving average outperform. We would define the signal, specify entry and exit rules, include costs and taxes, test multiple markets, compare risk, and ask whether the advantage persisted after becoming widely known. Process discipline turns chapter vocabulary into a repeatable workflow. And it also protects us from one of the most expensive behavioral biases in finance, the belief that our own backtest is special. The key relationship on this slide is intentionally written as an inequality. An observed price pattern is not the same as a profitable strategy after risk, cost, and implementation. The pattern is only the starting point. A chart may show momentum, reversal, support, resistance, or a moving average crossover. An anomaly study may show that one group of securities earned higher average returns. That is evidence worth investigating. It is not yet an investable result. Next comes the bias story. Perhaps investors underreact because of conservatism. Perhaps they overreact because of extrapolation. Perhaps loss aversion delays selling. The story can organize evidence, but it does not prove tradability. Humans are excellent at explaining a chart after the line has already been drawn. Then come arbitrage costs. Shorting can require a borrow that becomes scarce or expensive. Funding costs can rise. A position can move against the trader before the thesis resolves. Market impact can consume the apparent edge. In early 2021, investors shorting heavily discussed meme stocks learned that a crowded trade can become its own risk factor. A valuation argument may be sound while the short squeeze is busy ignoring it. Model risk also matters. The supposedly comparable securities may have different governance rights, tax treatment, liquidity, or embedded options. A closed-end fund discount may reflect fees, distribution policy, investor clientele, or expected tax consequences. The apparent violation of the law of one price may be partly a violation of the analyst's simplified model. Finally, validation is essential. The strategy should work outside the period used to create it, across reasonable specifications, and after realistic costs. It should not depend on one crisis, one country, or one lucky starting date. Capacity matters too. A small strategy can disappear when too much money attempts to use the same exit. The units also need to match. A signal is not a return. A gross return is not an abnormal return. An abnormal return is not a net investor return. Each step subtracts another layer of optimism. The practical question is not, can I see a pattern? It is, what economic mechanism creates it? What prevents correction? And what return remains after the market sends the invoice? Behavioral finance and technical analysis are related, but they do different jobs. Behavioral finance attempts to explain why investors may make biased decisions and why prices may depart from fully rational models. It focuses on mechanisms such as overconfidence, underreaction, extrapolation, framing, loss aversion, and limits to arbitrage. This framework is especially useful for investor coaching and process design. A written thesis, a predetermined sell discipline, rebalancing bands, position limits, and a decision journal can all reduce the effect of bias even when no market timing signal is involved. The weakness is that behavioral finance does not provide one unified predictive model. Almost any outcome can sound behavioral after the fact. A price rise can be called momentum. A reversal can be called overreaction. If the explanation changes every time the chart changes, the theory is doing public relations rather than prediction. Technical analysis uses price, volume, breadth, relative strength, moving averages, support, resistance, and sentiment indicators. A 50-day moving average smooths recent prices. A 200-day moving average provides a longer trend reference. Market breadth asks how many securities participate in a move. Relative strength compares performance across securities or markets. Sentiment indicators attempt to measure optimism, fear, positioning, or crowding. Technical rules have one advantage: they can be specified and tested. We can state exactly when to buy, when to sell, how much to trade, and what benchmark to use. That also exposes the weaknesses. Results can depend on the chosen window, sample period, rebalance frequency, and trading cost assumption. A moving average strategy may reduce exposure during prolonged declines, but generate repeated false signals in a sideways market. Finance calls that whipsaw. The investor may use a different phrase. Most importantly, a technical signal is not a valuation argument. A stock above its moving average may still be expensive. A stock below it may still be fundamentally attractive. The tools answer different questions. The better choice depends on the job. Behavioral finance may improve the decision process. Technical analysis may describe trend or timing conditions. Fundamental analysis may estimate value. A disciplined investor can use more than one lens, but the lenses should not pretend to be interchangeable. A chart can tell us what price has done. It cannot by itself tell us what the business is worth or whether the next trade will pay for the spread. Modern market technology changes the speed and presentation of investor behavior, but the underlying biases are old. What changed? Trading became easier, cheaper, faster, and more continuous. App-based platforms place quotes, charts, news, options, and social commentary in the same pocket as text messages. Zero commission trading reduced one visible cost. Those spreads, taxes, market impact, and behavioral cost remain. Fractional shares made access easier. Social media allowed narratives to spread globally before many investors had read the company's latest filing. What stayed the same? Overconfidence still encourages investors to mistake activity for skill. Extrapolation still turns recent performance into a forecast. Regret avoidance still keeps people in losing positions. Herding still feels safer than an independent decision because a crowded mistake offers emotional company. The ticker symbols change. The psychology did not request a software update. Who benefits? Investors benefit from lower access barriers, better information tools, and cheaper execution. Platforms benefit from engagement, assets, order flow, subscriptions, lending, and other revenue sources. Content creators benefit from attention. Market makers benefit from volume. None of these parties must be malicious for incentives to shape behavior. A platform designed to encourage frequent checking may increase anxiety and turnover even while providing excellent technology. What risk remains? Speed can compress reflection. Social proof can make a crowded trade feel independently researched. Options can create large exposure from a small premium. 24-hour commentary can manufacture urgency around events that do not change long-term value. The meme stock period showed how narrative, short interest, option activity, and online coordination can interact. Some investors earned extraordinary gains. Others entered after the story had already become the price. The same event supported multiple behavioral stories, which is exactly why evidence and timing matter. The practical response is not to ban technology or assume every retail investor is irrational. It is to design better process rules, written objectives, position limits, waiting periods for impulsive trades, valuation ranges, automatic rebalancing, and a requirement to state what would disconfirm the thesis. Modernization should not mean chasing headlines. It should mean asking 4 durable questions. What changed? What stayed the same? Who benefits and what risk remains? A faster trading button is still attached to a human thumb. Let us work through the practice case. An investor refuses to sell a losing stock because selling would lock in the loss. At the same time, the investor repeatedly buys recent winners after seeing them trend on social media. The first task is to identify 2 behavioral biases. Several answers are defensible. The refusal to sell can reflect loss aversion, regret, avoidance, anchoring to the purchase price, or the disposition effect. The purchase price has become a reference point, even though the market does not know or care what the investor paid. Buying recent winners can reflect extrapolation, representativeness, herding, fear of missing out, or overconfidence. The second task is to explain prospect theory. The investor evaluates the losing position relative to the original purchase price, realizing the loss feels especially painful, so the investor becomes willing to accept additional risk in the hope of returning to break even. This is risk seeking in the loss region. Meanwhile, a small gain on a winner may be sold quickly because securing the gain creates psychological satisfaction. The result can be a portfolio that harvests flowers and waters weeds. The third task is to name one limit to arbitrage in a crowded trade. A skeptical trader may face expensive or unavailable borrow, short squeeze risk, option-driven volatility, uncertain timing, margin requirements, or client withdrawals. Even when the crowd appears wrong, the cost of waiting for the correction can be substantial. The fourth task is to suggest a process rule. A strong answer might require a written thesis and valuation range before purchase, predetermined review triggers, maximum position sizes, scheduled rebalancing, a 24-hour cooling off period after a social media prompt, or a rule that the purchase price cannot be used as evidence of current value. Pause here and make your recommendation before listening further. A strong response might say, the investor shows loss aversion and extrapolation. Prospect theory explains why the unrealized loss creates risk-seeking behavior. Crowded winners can remain expensive because shorting is risky and timing is uncertain. The investor should use a written thesis with disconfirming evidence, a position limit, and scheduled review dates. The trade-off is that a rigid rule may force a sale before a genuine recovery, so the process should respond to new fundamentals rather than price alone. Grade for reasoning, recommendation, evidence, and trade-off. The point is not to diagnose the investor from a distance. The point is to build a process that still works when the investor is us. This slide highlights 5 common mistakes. Mistake 1 is assuming irrational investors automatically make markets easy to beat. Mispricing can widen. Arbitrageurs can be early. Shorting and funding can fail. The presence of bias creates a possible opportunity, not a guaranteed paycheck. Mistake 2 is using a behavioral story as a substitute for evidence. After a price rise, we can describe optimism, herding, and extrapolation. After a decline, we can describe panic, regret, and forced selling. A flexible story can explain everything and predict nothing. The mechanism must generate a testable implication. Mistake 3 is ignoring costs in technical trading systems. A strategy that trades frequently must pay spreads, market impact, taxes, and occasionally poor execution. The backtest often assumes every order fills at the closing price because spreadsheets enjoy a relationship with liquidity that actual traders can only envy. Mistake 4 is mistaking a moving average signal for a valuation argument. A trend rule can help manage exposure or describe momentum. It does not estimate the present value of future cash flows. A stock can be above the 200-day moving average and still embed heroic assumptions. It can be below the average and still be cheap for a patient investor. Mistake 5 is treating regret avoidance as risk management. Holding a losing security because selling feels painful is not the same as accepting risk deliberately. Refusing to recognize a loss can increase concentration, opportunity cost, and exposure to a broken thesis. Emotional comfort and financial control are not synonyms. A few additional mistakes are worth remembering. Do not treat every investor action as a bias. Sometimes the investor has different information, taxes, liabilities, or constraints. Do not infer causation from a return pattern alone. Do not test a strategy on the same data used to create it and call the result independent evidence. Do not confuse a signal's hit rate with profitability. The size of gains and losses matters. The easiest errors usually come from skipping fit, risk, cost, assumptions, or mechanism. A confident answer may still be incomplete if it does not say why the effect should exist, why it should persist, and how the investor gets paid. Behavioral finance should make us more humble about decisions, including the decision to declare everyone else biased. Here's the knowledge check. Which bias involves people inferring patterns too quickly from limited evidence? A, extrapolation. B, duration risk. C, tax arbitrage. D, market capitalization. Pause for a moment and choose an answer. The correct answer is A, extrapolation. Extrapolation occurs when investors take a recent or limited pattern and project it too far into the future. A few quarters of rapid growth may become a permanent growth assumption. A short winning streak may be treated as evidence of skill. A recent market decline may be expected to continue indefinitely. The sample is small, but the conclusion arrives fully dressed. Duration risk is the sensitivity of a bond's price to changes in yield. Tax arbitrage refers to strategies involving differences in tax treatment. Market capitalization is the market value of a company's equity. None describes rapid pattern inference from limited evidence. A useful follow-up question is how extrapolation differs from conservatism. Extrapolation updates too aggressively from a small or recent sample. Conservatism updates too slowly despite meaningful new evidence. One bias races ahead of the data. The other asks the data to wait in the lobby. This is a low-stakes retrieval check, but the real assessment is application. Given an investor chasing a recent theme, can you identify the limited sample, explain the forecast error, and propose a process rule that reduces the risk? That is the difference between recognizing the word and using the concept. Let us close Chapter 9 with 3 takeaways. First, behavioral biases can affect both market prices and individual investor decisions. Overconfidence can increase turnover and concentration. Conservatism can delay a necessary update. Extrapolation can turn recent performance into an unrealistic forecast. Framing, mental accounting, regret avoidance, and loss aversion can cause economically similar choices to feel very different. Second, mispricing can persist when arbitrage is risky or costly. Fundamental risk, model risk, short sale constraints, funding pressure, timing uncertainty, transaction cost, and client withdrawals can prevent sophisticated investors from forcing prices immediately toward fair value. Recognizing that a price looks wrong is not the same as possessing a safe trade that will correct it. Third, technical indicators need evidence, not just a plausible story. Moving averages, breadth, relative strength, support, resistance, and sentiment can summarize market behavior. A useful strategy must be specified in advance, tested out of sample, adjusted for risk, and evaluated after cost. A chart pattern is the beginning of research, not the graduation ceremony. After the slides, the homework asks students to prepare a behavioral bias diagnosis memo. The discussion asks whether investor biases are a reason to trade more or trade less. The quiz covers information processing errors, framing, prospect theory, limits to arbitrage, bubbles, technical indicators, and the difference between description and profitable implementation. This chapter also provides a practical investor lesson. Good process can reduce the need to predict our own emotions perfectly. Written theses, disconfirming evidence, position limits, rebalancing rules, review dates. In cooling off periods, create guardrails. Before the market becomes exciting, the goal is not to become emotionless. That usually produces either a robot or a very strange dinner guest. The goal is to prevent temporary emotion from becoming permanent capital impairment. The next chapter turns to bond prices and yields, where cash flows and discount rates take center stage. Behavioral forces do not disappear, but the mathematics becomes more visible. Finish with the question on the slide. What would change my recommendation? What evidence would weaken the behavioral explanation? What cost would eliminate the technical edge? What new fundamental fact would justify holding the loser? What portfolio constraint would make the crowded winner unsuitable? A strong investment process does not ask only why might the market be wrong? It also asks, why might I be wrong, and how expensive will the lesson become? Och så håller jag